So first and foremost, my name is Sean Kozak. I'm one of the co-founders here at ARC. I'm the acting managing partner of the NeuroStreet ecosystem, and I love algos. I love everything about automation. I love automated strategies. I love building automated systems. I love selling automated strategies. I love seeing traders crush the market with our strategies. Everything about automation plays a special tune in my soul, and I'll tell you why. Because I've been in trading for a very long time. And I've been building trading software and systems for a very long time. And I've seen the good, the bad, the okay, the ugly, the not so good, the not so bad, the amazing, right? I've seen it all. I promise you this. And there are certain ways in which day traders can approach the market that will dictate different types of results. Okay. And so some of these webinars that I do, I really get emotionally connected to them because I truly believe in the power behind what they're doing, right? And some webinars are great. Some webinars are even much better than great, right? You can be the dictating, deciding factor of that today. My job is to deliver a jam-packed presentation to hopefully kind of pique your interest and get you to understand today's algo concepts. Some of you ask, why do we have so many automated strategies? And the answer is because that's our job description. we are in the business of building trading systems, and a lot of them. In fact, our mandate is to develop strategies every 2 weeks. We've got several months already mapped out for systems, and the reason for that is ARC's mandate. We spent years building indicators. We've got over 50 to 60 different indicators, and we are now spending years building automated systems. In fact, it's more of a passion than anything. We love it, and there's a reason for it. As you know, we've just acquired the TickBlaze platform. TickBlaze is a very heavily known for its algorithmic trading capabilities, and we are going to be bringing all of these algos into TickBlaze, and there's a future there, and we'll get into that after. But nonetheless, we are here today to talk about the engulfing system. And before I get into this, I just want to kind of give a little bit of a backstory to what we're doing. And just so you guys know, we are recording this event. We'll give it to you, send you out a link to the recording. I don't go over the Q&A so much in the presentation because I need to stay on topic as best as possible. And that way I can reserve time at the end for some Q&A. But for the most part, if you're interested in day trading, this is going to be an event that should interest you more than most, I would say. And I'll explain why. The number one reason traders struggle, and this isn't just some jargon slogan, like the real reason traders struggle is because they try to stop the market. Like I know that there's a lot of people in here that say, okay, I want to fade the market. I want to go against. I'm a contrarian thinker. But more times than none, the market is going to run you over if you're on the wrong side of it. How many of you guys remember the moment, or maybe it was recently, where you got into a trade, you thought the market was going in one direction, and it completely, right, the other way? Like it just rolled over. It just flattened you. We've all been there, right? Normally, it's a miscommunication between your perception of the bias. Normally, it's because you're thinking the market's going to go this way and it goes that way. Or maybe you're just not reading it correctly, okay? Today's presentation will basically solve that problem, right? We have built a strategy. Its entire job is to be on the right side of the market. Like that's all it's designed to do, is to make sure that you are never fighting the current. You are always on the right side of the market, and you are in the market for quick wins, quick and effective wins. And there's different ways to look at engulfing patterns. I'm sure, how many of you guys have ever heard of the term engulfing before, right? There's many different ways to look at engulfing patterns. We've developed a new way in how we look at body engulfing ratios, and we, do some pretty unique stuff with this, which is why I'm very excited about this, because the results are just nothing short of amazing. But for the most part, this is going to keep you on the right side of momentum 9 times out of 10. And if you're somebody that's looking for a lot of trades, this is going to be the system for you, right? You can dial it up, dial it down, but we've got some pretty sexy templates that are going to rock you. And I'm excited to share those with you today. Now, because we've got an algo to talk about, I need to cover the disclaimer. So can you guys do me a Y in the chat box? You accept the risks in the business. You know that I can't guarantee you performance. I'm not your advisor, CTA, and all that fun stuff in between, right? We've been there, done that, got the t-shirt. Thank you, appreciate it. I wish I could guarantee you results. I wish I could give everybody the magic spoon, but I can't. Right? So I'll give you Aladdin's lamp and you get 3 wishes. But I'm not the genie. I'm here to help. So I do things a little different. A lot of you are used to my presentation style. Some of you are completely new to me. I just get right into it, right? I really don't care about the fluff or the boring stuff, or I just, what's the point? Right? How many of you guys have been to webinars where all we do is we just go over a bunch of stuff you've heard 50 times before and you're just sick of it? Give me a yes if that makes sense to you. I mean, how many of you guys have been to a webinar where you've heard the same shit 10 times spun, twice removed, right? Yeah, okay. So today it's about 2 things, teaching you the setup and showing you that it works. How many of you guys are okay with that? Just get right to the point. Show me the entry, show me how it works, show me the signal, and show me, is it making me some freaking money? Right? Make sense? Give me a yes that we're on the right track. Okay. So these are the 2 different trades. They are momentum trades. This is an example of what a profitable trading system should look like. You will have some drawdowns, but it needs to go up and to the right. If it doesn't, you have a problem. Okay. So how many of you guys could say that you've made, over $10,000 in the last 2 weeks? How many of you guys have made over $10,000 in the last 2 weeks in the market? If you have, type a Y in the chat box. If you haven't, type a no in the chat box. I want to know. A couple of yeses, good for you guys. A lot of no's. Okay. So my job is to give you software that can generate the results that you want to make. And you need to first define what you want to make before we can get you to what you can make. Okay. So there's some risk management discussions that need to be had. You need to understand the risk. You need to understand the money management. You also need to know if you're trading for your own account or for a prop firm. How many of you guys are trading for evaluations, whether that's Top Step, whether that's Apex, whether that's OneUp or Earn to Trade or wherever? I don't care. Give me a yes if you're in that wheelhouse right now. Yes, some of you are trading for your own accounts. Great. Everything with this system is designed for day trading, either your own accounts or for prop firms. Yes, you can use this strategy and this system and our strategies for prop firms. We'll get into that in a minute. Now, I don't know what you're struggling with. I really don't. Some of you are struggling with knowledge. Some of you are struggling with computer acumen. Maybe you're a little bit slow around the computers. Maybe you're just getting into the business, right? Maybe you are an emotional wreck. I don't know. Everybody comes from a different walk of life in this business. I can promise you that. But I know that we all want the same thing. How do I know that? Because anybody that is in this business for anything other than the same things would be considered weird, right? If you came into this business and you told me, I don't really want to make a lot of money, I would look at you a little bit strange, right? And you need to have it consistently producing. Like if you made money on Mondays and only on Mondays, well, then maybe you're a Monday trader. But the most of you are looking to make money every single day to the best of your abilities. Give me a yes that that is true. I need to know if we're on the same page here. We want to make money all the time and as much of it as possible. Okay. So if we know that, there is 2 things that have to be understood. Number 1 is you need to understand is, do you have the strategy that can produce that? And are you willing to get out of the way to let that happen? 9 times out of 10, the biggest barrier to the results that we have is us. I hate to break it to you, but the market is the market. It's how we participate in it that dictates the results we get. Now, some days the market's going to throw you a curveball. That's life. But on most occasions, if you've got a really good signal and you know how to exploit that signal, you should be okay. Okay. Now, this picture here, I chose this picture on purpose because I like day trading action. I like one and dones, right? I do like one and done trades. There's a time and a place for trading the open. Okay. There is definitely a time and a trace to trading the first trend pullback on volume or trading the open on order flow. Absolutely. But if you're somebody that's looking for very powerful trades and you are on the right side of the market, you don't need to be on the right side of the trend. I'm not saying you need to time impulse 1 and pull back 2 and break to the 3 impulse. Like, doing all that can be difficult. I'm talking about when the market is ripping in one direction, even if it's for one leg or if it's for a couple legs, you just want to be on the right side of that to take a piece out of it. You don't need to be the jack of all trades and take the whole move. A lot of you, myself included at one point, I always tried to be right all the time. And being right left a lot of money on the table because I was always trying to force an outcome that didn't have to happen. You just need to get in and take your profit and do that consistently. And in order to do that, you need to have a good read of market momentum, the move of the market, right? And let me give you an example. Okay, I'm going to grab a cursor here. Okay, so I'm going to do this here. Okay. Give me 1 second here. Every time it wants to do this. Yeah, I'm going to show you that. Give me a second here. There you go. Sometimes I use these draw tools and they don't let me draw, so I got to go into this. Okay. So let me do something here for a second. I'm gonna draw something for you because this is gonna resonate with you guys. I can promise you this. If I've got a trend and it's going like this, okay, the problem, or even if I've got a market and it's going like this, sometimes the markets are going like this, and sometimes the markets are going like this. This is dangerous. The tight coils, that's dangerous. Now, normally these tight coils are not meant to be traded. Most traders with a little bit of experience will know when you are in a coiling spring, there is no movement. You're either waiting for a news pop or you're right around a big EMA or the market's just stalled out. How many of you guys know what I'm talking about? When the market's just doing this, you've seen it. You're like, okay, what the hell is going to happen? What's going to move? Like, you get it. It's the worst situation. Most people can't trade in that. Those really, really tight consolidations. Okay. Unlike tight consolidations, you can have markets that are going like this and going like that and going like this and going like this. And like, you know, like that is tradable. Why? Because those are large oscillating swings. This is tradable. That is tradable. This is tradable. That is tradable. You know the best part about momentum? And this is the unique part about this discussion is that momentum can exist properly in every single one of those scenarios. That is the uniqueness of this discussion today. All the time I get traders, Sean, can you get me a strategy that I don't have to worry about the conditions of the market? Okay, Sean, I have a great reversal strategy, but what do you do in a trending market? Okay, and then you get the guys that, okay, Sean, I've got great trending strategies. What do I do in these oscillating markets? Do you understand my point here for a second? How many of you guys are faced with that, right? You see some days the market's trending, you don't know how to trade your reversals. Other days the market's reversing, you don't know how to trade your trends. Momentum done correctly can live in this leg and that leg and that leg, this leg, and this leg. Momentum can live in a parabolic market, Momentum can live in the big swings of an oscillating range. How many of you guys understand what I'm trying to do here? I'm trying to show you that the power of using the right signal, okay, the power of using the right signal can participate in any scenario that you are placed with as long as the pattern presents the confirmation. That's why I'm excited about today's webinar, guys. Now, take a screenshot of this. If you haven't heard me say this, if for those of you that are new in here that don't know anything about automation, let me just sum it up for you. 9 times out of 10, automated strategies will outperform a human being. Why? Because we're emotional creatures and we get in the movement of the strategy. We get ourselves in the ball. We talk ourselves out of trades. We step into a winning trade. We cut we cut our stop losses. We move it like that's just the reality, right? Like we're human beings. Like give ourselves a break, right? We are tied to an outcome and we are tied to the money attached to that outcome. So the moment we know that, we can remove ourselves from the equation and we can look at automation. Now, automation has a lot of benefits. A lot of benefits for efficiency. It can do things that humans just can't do fast enough. We can't act quick enough under pressure. We can't see things fast enough as it's happening. We miss trades. Most importantly, it's not systematic, where most of us are not systematic. Okay. The big one for me, and I always talk about this, is data. And this is the big one for me. And this is always going to be the big one for me because it has to give some type of evidence. Like if I'm a manual trader and I'm over here and I'm an automated trader over here, I know that I can use automation to show me if I have an edge to some degree in the past. The future is always unknown. That's called forward testing. That's called forward trading. That's called out of sample testing, Monte Carlo simulations, whatever you want to call it. But if you go back to the manual side, 90%, I'm not going to say all traders, a good 10% of traders will log their trades. There are a few in here that are doing a great job of it, and you owe yourself the credit where credit's due. You've put in the work. You've probably had struggles before, right? But the other mass quantity of people in here are not logging every single trade. And you're not taking trades in a systematic basis where every single day you can exploit that information to determine if you have an edge. So you don't even know if the data makes sense, which is why systematic trading is such a different advantage point to human results in this industry. Like now, I do believe that if unattained, if you try to automate strategies and you don't know anything about it, that's a risk that you're not ready to take. Or if you don't know how to use the tool or you don't know the settings, well, now we're just talking negligence. We need to understand the tool. That's my job. That's my staff's job, to make sure you understand how to use the software. But your job is to make sure that you're no longer trading something that you do not have an advantage point on. If you are approaching the market and you have no evidence that what you're about to do has an edge, you are really, really pushing the boundaries of your own success in an unhealthy way. That's like going into a casino and saying, I got this stuff figured out. Like that's dangerous. So the reason I suggest considering automation is because it has been proven over time to generate better alpha for even the most inexperienced traders. Experienced traders can benefit. Inexperienced traders can benefit even more because you're not plagued by the disbelief or the problems of the past. How many of you guys can relate with that? Sometimes it's better to start off new with the right mentors than to go down years of wasting time. Some of you can relate with that. Bad habits can plague us. Now, let's get out of this for a second. And you're going to see me talk about things that are a little bit different with our algos. I always like to lead with this because it's very important you understand the difference between just buying a strategy that is available in the market or buying a strategy from ARC AI. We decided over 2 years ago to rebuild the engine for the strategy analyzer inside of Ninjatrader. We knew that if we were going to build automated strategies, we had to rebuild the platform infrastructure from the ground up. What does that mean? Well, anybody can trade a signal. You could buy a signal anywhere. You could go and buy a black box, or you can go and buy something from anywhere. A lot of vendors charge thousands of dollars for a black box or a signal, but you don't know how to make the strategy better. Like you're at the mercy of whatever they sell you. And if it doesn't work, you have no way to improve it, edit it, optimize it, structure it, nothing. The other side of this is that ARC has an entire team, not just one event. Like we have an entire team, and our job when we build software for the retail users and the strategy users in this industry that we sell to, we build the software first, then we validate it. We need to validate it before we can ever decide if we're going to sell it. We can't just sell a strategy that has no merit. I mean, that would be a losing business model for us as a company. We can't sell something that doesn't work. But the way we prove that it works is not just relying on the entry signal. The entry signal is only 50% of the equation. We need to determine money management. We need to determine the stop size and the target size. And are we going in with one exit, two exits, break even, trailing stops? We need to determine the way in which we trade the strategy. Are we only trading it in the morning? Are we trading it in the afternoon? Are we blocking news? Are we blocking lunchtime, etc.? We need to know, are we trading it with a trend behind us or no trend filters, momentum filters, no momentum filters? You can kind of understand why I'm saying this, because if you have a system and you have no way to go and get that strategy and make it better, you don't have anything. That'd be like buying a business, and then if the industry changes, you could never improve your business. That's catastrophic. So what we do with ARC is we have a core engine. The engine is the backbone to the signal. Think of it as a two-part equation. Let me just draw this here so you guys can understand this. Every algo, the algo equals the signal plus the engine. Together, they give you alpha. Because let me tell you something. If this is done, but this is not done, wow, you are in a world of hurt if you're trying to automate systems and keep them profitable. Okay. And so why I'm saying this is that we do this for you. You don't have to figure this out. In fact, we've done this so much that we've just brought on a team of ambassadors, traders who were customers like yourselves. I think some of them are even in here now. And they are now working with our dev team to build templates for all of our members. Because we know that a lot of traders want the assistance of having profitable trading systems and templates. And it's a lot of work to keep things ongoing by yourself. We are doing that for all of our members. We're posting them in the Discords. We are keeping things active. This is how we do it. The engine is how we do it. The signal is just the entry. So what I'm going to do is I'm going to share with you. Okay. I'm going to share with you now the entry information. I see some comments in here, and I'll go into those comments for Federico. I will answer your question. I didn't read it, but I will go over it in a moment here, guys. So does everything make sense up until now? Can you guys give me a Y in the chat box that this makes sense to you? I want to make sure that everybody's on the same page. I know some of you are repeat attendees and some of you are new. Okay. I like to repeat things that work well, right? I don't change things that are not broken. So this signal, which you're seeing here, is a momentum trade. Okay. It's fully automated. Predominantly built for scalping. It could be used on any time frame because the pattern repeats on any time frame, any bar type. What I like about this is that you're always on the right side of the market. This signal will not produce itself if it is on the wrong side of the market. It can't. It just doesn't make sense to have it self-apparent in the wrong side of the market. That's why we call it the engulfing algo, because the market is going to wipe the slate of anyone trying to fight the force of the signal. Now, it auto-adapts your trading plan, so you don't have to do anything. Literally, you just define the data, the time frame, the bar type, the market you want to trade it on, and it suits your fancy. Okay. Now, I'm going to go into the signals for a second. Okay. Now, you're going to say, well, Sean, I've heard of an engulfing pattern. Sure, we've all heard of engulfing pattern. Most people think an engulfing pattern is an outside bar pattern. It is formally somewhat of an outside bar pattern, but this is not that. Okay. What do you think matters the most in trading? The range or the body? This is very important. What matters most, the range or the body of every single candle? And this is a skill testing question. This is really important. I'm seeing mixed answers. People, how many of you guys don't know the answer? Just type a question mark if you feel like, okay, is this a trick question? Okay. So let me just do this. This I like to educate a bit where I can, and I'm gonna rip open the hood a little bit. Okay. So when I have a candle, what does the range tell me? You guys tell me, what does the range tell me of a candle pattern? And it could look like this. 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 Right? It could look many different things, right? Like there's many different ways to cut it, right? But if I have a candle, the range just tells me where prices went to. It creates the environment. But the body dictates where it closes, and it tells a story about participation. It tells a story about conviction. It tells a story about the flow of the market. Now, if I have a candle that opens here, it trades lower a little bit, and then it goes all the way up here, trades a little bit higher like that, but it closes here. This is the close. This is the open. That tells a pretty significant story. It tells us that it went all the way here, but the market rejected these areas and it went all the way up and it closed here, right? Now, this could be on a 1 minute, a 5 minute, a 10,000 volume chart. It doesn't matter. What it matters is that during the life of this time, remember, everything is about the auction. Everything is about the auction. A lot of people forget about this. They lose sight of what's going on the prices. They just get sucked into the bars. What this means is that during the life of this candle, these price levels were rejected. No go. And therefore, the market favored direction up to here. Does that make sense? That's what the story is telling you. And what we're doing is we're looking for patterns where the body is engulfing the 2-bar display, the other bodies of the pattern. And why is this important? Well, there's a few other factors. We've got a few things going on in here. Like, I'll give you an example. This candle body. How many of you guys would think that that tells a story right there? What does that tell you? What do you think that small little story tells you? It tells you absolutely nothing. It tells you nothing because there's not enough range, there's not enough body inside of that movement. Okay. Now let me go to a different example here. Okay. What about that? What do you see here? Okay. Now let's just take a look here. You see this candle here? You got the range, you got the range, you got a body in here. What does that candle tell you? You tell me the difference. Like that entire candle's body tells a story relative to the prior candle's price action. Okay. Now, the thing about the system is that most people think, well, that's easy. I could do this on my own. No, you can't, because every pattern's different. Every single pattern is going to throw you for, is that a pattern? Is this a pattern? You will never be able to determine this quickly in real time, because every single bar's range is different sizes. Every single bar's candles are different sizes, which means we have filters that we optimize to check the candle body's range and the candle body's body. And then we check the relationship to the engulfing of the momentum bar, which is the engulfing pattern, relative to the range and the size of the bodies of the candles. It's very important to understand that. You can't just have any size candle and it makes sense. Now, let me explain this for a second. That's how you know the data. The data supports the decision. So let's go in here and take a look at a few different examples, okay? Take a look at this pattern. This candle here had an up candle, and then the next candle down here. This body tells a significant story to this bar's relationship. But then if you compare this candle, take a look at this. You see this candle right here? It looks completely different than that candle. And this is what's unique about this, is that it's not the pattern of where the candles are closing. It's the story of the body's size to its range ratio. The body's size relative to its range ratio. I know that's a tongue twister, but the range ratio, what does that mean by that? If I've got a candle, it's like this, and I've got a small body, that's got a small body to range ratio. Why? Because the body's small, but the range is big. This one here, same thing, small body to range ratio. If I had a candle that was like this, that would be considered a large body to a large ratio. And I can still have an engulfing pattern take both of these out. But the relativeness of this versus this is completely different. And so our software is going to optimize the size of the ratios to dictate the best engulfing scenarios. Like it's going to find the best pattern recognition that it can possibly find. And we must have a large enough body engulfing scenario where the bodies are dwarfing the bodies of the other candles in those scenarios. Does that make sense to you? I know that kind of sounds complicated. It really isn't. It's more of a body engulfing scenario, but we use a little bit more math on the back end to verify that it makes sense. Because I could have a candle like this, and it's like this, but it's not significant, right? Like the body and the range are not significant, so we would negate stuff like that. It has to have impact. Okay. Now, this is not a trend. This is just a leg down. Look at this, just a leg down and a leg up. That's not a trend. Right? And you're taking trades on both sides of this. Now, you'd say, well, that's not that crazy. Like, I think that's easy to trade. It is easy to trade when you automate the signal. And this is what the results were on the S&P template over the last couple of weeks. We'll show it to you. We did $18,000. This is as of Friday. Wait, is today? Yeah, Friday, I think it was. Yeah, Friday. Yeah, 18 grand in the last couple of weeks. Took 100 trades. So let me go over something. A lot of people always ask me this. Okay. Are you guys okay with me kind of ripping off a Band-Aid for a second? Are you guys okay with me kind of like telling people what they need to hear, not what they want to hear? Okay. Because I'm going to teach a few of you guys a few things that are relevant, and take this down. It's very important. Okay. Day trading is not swing trading. Okay. Let's talk about what we call sample size. Okay, we're going to make this bigger so you guys can see it. Sample size equals all. I'm a stats major. I specialize in stats and mathematics. That's what I went to school for. That's why I love quant so much, because it's all data-driven information. And stats don't lie. Numbers don't lie. So, sample size. If I'm a day trader, there is no relevance to trying to go back 6 months to a freaking year. I get some people write in, show me a back test that is profitable for 6 months of a year. My response to them is go back to school. You clearly don't know what you're asking. Now, why am I saying that? Because what happened this week has no bearing on the condition 6 months ago. Completely two separate sides of the universe. If you're trading in the morning for 3 freaking hours, what happened this morning is completely irrelevant than what happened 9 months ago. You're a day trader. The market is not relative to your fractal. Markets are fractal. If you're a day trader, you're looking at a very small fractal. What do you think matters more for day trading than anything? Number of trades. You need to look at relevance and repetition during time periods. Why? You're a day trader. It matters when you take those trades. Now, if you're a swing trader or an investor, now that's different. 6 months, 1 year. Yes, yes, yes. Now you're speaking the right language. If I'm a swing trader, a day trader could give me 100 trades in 4 weeks or less. As a swing trader, 100 trades could equal 1 year or more. No kidding. A swing trade requires large lookbacks for sample size. You need to know that your signal has an edge. As a day trader, focus on sample size. Don't focus on time horizon. The markets are erratic. News events can throw a complete condition situation out of whack. You could have your strategies optimized for trend trading, and then all of a sudden CPI comes out and floors everybody, or GDP changes the dynamics fundamentally, and nothing matters anymore. Week to week fundamental news dictates day trading conditions, which is why you can hear the passion in my voice in trying to correct the negligence of people that don't understand the importance of that. So whether you buy a system from me or you buy it from any other guy in the business that sells strategies, don't confuse sample size with look back periods. It will not make or break your system's performance. It makes or breaks how you relevantly trade it. It will make or break how long you should be testing for, how many optimizations you should be running, et cetera, et cetera. So if I'm a day trader and I'm trading for a prop firm, I can't even hold the position overnight. Why would I ever look at sample sizes that are relevant to anything outside of day trading? Right? Shai says 7 to 10 days max. You've spoken like somebody that starts to understand more of a quant perspective, right? But you have a little bit more experience, Shai. I know you. We have history. Okay. So does everybody understand why I'm trying to drive this nail into the ground right now? Because I'm more focused on sample size than anything, because that's the relevance of the strategies and the audience. I like to see 50 to 100 trades for me to even consider it. Because let's face it, 100 day trades, that's a lot of freaking trades. Like, you could go to a hedge fund that swing trades or invest in the market. They haven't taken 100 trades in the last 3 years. Right? Now you're talking different relevance. Give me a yes if this makes sense. Okay. I want to make sure that you understand this. It's very, very important. So if you've ever felt that you're asking for, you want a strategy that shows me 6 months of performance, you need to move out of the day trading realm and go into the investing realm, the swing trading realm. Completely different ball games. Okay. Now, I want to talk a little bit about money management. Why? Because most people don't understand its impact. When you're trading strategies, okay, and you have a strategy and you have to sit there and change your position sizing, what would dictate the change of your strategy's position sizing? You tell me. What do you think will change the position sizing of your strategy? You guys with me? The risk, your entry to your stop loss equals risk per trade. Yeah. Small stop equals smaller what? Some people are going to say risk. That doesn't mean that smaller risk. A smaller risk stop does not mean smaller stop does not mean less risk. It just means smaller distance. Larger stop equals larger distance. Why? Because money management equals risk per trade, which means if I have a smaller stop loss, normally this means more contracts. If I have a larger stop loss, this means less contracts. The summary, each should equal the same. If you set your risk per trade the same. This is important. Why is this important? Because everybody in here said they're trading for a prop firm, 95% of you. So prop firm risk equals dollar value risk per trade, not percentage risk per trade. Let me explain this. If you're trading for evals, Top Step, Apex, ours soon, coming soon, very soon, whatever the case may be, okay, is if you have a $2,500 drawdown and you're trading a 100K account or a 50K account, 1% of 50K is what? 1% of 50K equals what? You tell me. Let's see if you guys are thinking here like a risk manager. $500. If you're risking 1% of your prop firm account, because they give you $50, 50 grand, they tell you, right? And then you know you got a $2,500 drawdown. Well, that just means you got 4, 2, 4, 5 trades equals 5 trades before you blow out your account. That's crazy. Prop firms are not designed for percentage risk. Prop firms are not designed for you to use fixed fractional money management, which is why we don't do that. Our algos are built for prop firm traders. Set your dollar value risk per trade, $100 a trade, $200 a trade. Just set the risk per trade and earn your right to a PA account, earn your right to a funded account, and stay funded. So many traders get funded and then they never stay funded. They never stay funded because they work day. They keep going day by day. Yay, they get funded. Then they want to scale capital and they change the dynamics. They figured, okay, now I'm getting a little bit confident. I'm getting a little bit, they lose sight of that using the money management. You should treat your approach to risk management the same way as if you were getting funded and you were staying funded. If you use a dollar value risk per trade, what this will allow you to do is it'll allow you to control the narrative without blowing out your evals. And our stop losses automatically adapt, which means if the stop loss gets a little bit bigger, okay, it's going to drop your contracts. It's going to still stay the same. If you set it to $500 per trade or $100 per trade, it's going to auto adapt your money management. It's going to auto adapt your money management. Does that make sense? Give me a yes that you guys are starting to understand the importance of this. Promise me, if you're using our algos, you set your dollar value risk appropriate, because we spent a lot of time building this so that you guys don't blow out your accounts. Very important. Okay. Now, I want to talk about something here. Jim filmed a nice little demo video. Okay. I'm going to share the audio. Okay. Just a quick 1 trade long, 1 trade short. Okay. I'm going to press play and we're going to watch this. Okay, guys? I like to show demos. It's hard for me to do that in real time because I don't know what the market's doing right now. So I don't know if there's a momentum trade right now. Right. But I want to basically show now. He's going to show a long and then he's going to show a short. Okay. And we're going to talk about what this is doing.
Hey traders, Jim Simmons here with ARC AI, here to do a quick overview of the all-new Engulfing Algo. So let's see it in action first, and then we'll break down the trades after. Here we go.
Can you guys see the signal? I want to know if you guys can see it. Yes? Now, I'm going to stop you here. Take a look at this down candle. And take a look at that up candle. It's a little different than what you've seen before, right? You remember what we seen before? You had a down candle and the body was small. Okay. And then you had a big engulfing pattern. This one, you had a very big body down and you had a really big body up. They're two separate patterns with two separate relationships to the body and range ratio. Remember, the engulfing must encapsulate the body range ratio of the pattern. And that's why the system's so unique in that it looks at the pattern differently. I can tell you right here. Let me take a look here. Yeah, I'll just let it play. Okay, I'm going to just let it play. So this is going to pump to the upside. Eventually, it's going to take a couple bars to do this. Okay. This pattern is going to get you into the market, whether you're in a trend or you're in a momentum environment. It didn't go short because it's long, Abdu. It's a long engulfing. Yeah, the engulfing pattern is encapsulating the short. Yeah.
Okay, so let's break down the trade. What do we have going on here? So we've got the high created here. We've got a nice little pullback. This is a 2-bar pattern, and what's happening here is we have a down bar, and then the up bar has to completely engulf the body of the down bar. So the body of the up bar has to engulf the body of the down bar. So once that happens, we get our signal, enters long at bar close, and stop goes below the low. Target is set to 1-to-1. So that's the trade.
So I'm going to pause it here. Now, he doesn't have the signals going on everywhere else on this trend right now because he's turned it on purpose to show you this signal. Can anybody else see the signals here? I just want to see if the eye can catch them. Okay, let me circle them for you. There's a pattern here. There's a pattern here. Completely different pattern, different range ratio patterns. Pattern here. Can't even see it. We don't have it turned on. We started it here. There is going to be these patterns on the chart. And if you're on the right side of the market, you will be grateful that you are, because these patterns are the initial stage of the market kicking in. That's why we call it the engulfing. If you're on the wrong side of it, you're most likely going to get engulfed by the next big push, right? And it doesn't matter if you're in a trend or not, right? You will catch these patterns. So let me press play again and let's keep it going. So this market's going to pump quickly because normally they pump really quickly.
Okay, so let's break down this trade. So again, 2-bar pattern. There's our up bar, there's our down bar. The down bar body completely engulfs the up bar's body. So that is the engulfing pattern. Again, trading at bar close, stop goes above the high, target 1-to-1. So that is the all-new engulfing algo. We'll see you in the AMA. Enjoy the rest of the event. Cheers.
Okay, so let's go in here for a second. I want to talk about this. I'm about ready to show you 2 different system templates. Okay. The reason we only did these on the MES and the MNQ, why do you think we focused on the MES and the MNQ for this algo? Let me see if anybody gets it. Want to know, because there's a lot of traders in here. They're the best for movement. Okay. Less risk, volume, management, prop risk, fast. Okay. Great. Okay. Well, first of all, right, as a trader, most people flop markets because they're trying to find more trades. Right? Oh, I need to go to crude. Oh, I need to go to the euro, or I got to go to gold, or oh, whatever the freaking case of whatever's, right? If you don't have to move a market, why would you? Why would you switch markets if you don't have to? It's added risk. It doesn't make any sense when you're trading thin markets. Gold is very thin. Crude is very thin. The Russell is very thin. The YM is very thin. right? Less volume. If we can produce, okay, if we can produce strategies on a market that is hitting on a regular basis every single day, okay, that is important. Now, there is some keys around diversity, correlation. Yes, I get that. But let me give you an example, right? If you had an opportunity to simplify and scale, why would you want to make things more complicated? Okay. Give me a yes if that makes sense to you. If I could give you 2 profitable system templates on the 2 most actively traded futures contracts in the world, would you be okay with that? Great. Okay. So what we're going to do is I'm going to show you these strategy templates were for the last 100 trades for both markets. Slightly different results, slightly different time frames. Both of them were on volume charts. Let me ask you a question. Why do you think we used volume charts for this example? This is where we start bringing in some experience. I'm going to drop some golden nuggets for you guys a little bit. I want to ask you, okay, we've got 3 predominant types of candles that we could use for this that I think, you know, kind of have merit. What do you think they are? Time, tick, and volume. All 3 of these create variable range candles. If I have a pattern that goes like this, I got a trend. Let's just say I got the EMAs, right? I got the EMAs. Okay, going like that. I go like this. This is time. This is tick. And this is volume. Okay. And I get a down candle. And I get the pattern. Boom. Here, a down candle. I get the pattern. A down candle. I get the pattern. Okay. If I had an engulfing pattern that was based off time, does time tell me anything about the activity of the market, transactions, or volume sentiment? Time is a very good system template. Like, time is very easy to test. It's very accurate. The closing price is constant, which is very, very important to understand when it comes to system mechanics. But it doesn't give you any insight into the information of the data. It just gives you time, which is a static factor. Tick and volume, they're unique. Why are they unique? Because they're non-static variables. Now, I know I'm going into some pretty advanced shit here, right, guys? Bear with me here. Okay, I'm going to just tick looks at the number of transactions. The volume looks at the size of those transactions, the amount of volume executed. Tick is the amount of ticks executed. Okay. Which one do you think would have more power? The amount of transactions, the amount of time, or the amount of volume? Volume. The reason we didn't build these in time and tick is because volume has a massive impact on the market. And if your engulfing pattern is created on volume, what does that mean? When I have an engulfing pattern that is engulfing on a volume chart, it's telling me that this is now a volume engulfing environment. Without us even having to build a volume-based system, we can use volume-based bars, keep things simple, give you a much better edge, which is why we had so much profitability on these templates. And this is, Jeff, you can tell me, but you're kind of biased to volume. You and I always gravitate to volume.
Yeah,
It's
like volume. Volume works
volume
good.
is good. Volume tells a different story. Okay. So a couple things. We're going to go through a demo. Okay. Let me show you some examples here. Let's go on a chart. Okay. So you're going to see a bunch of trades here. Why? Because there's just a bunch of trades. Okay. Let's take a look here. Look at this. There's an engulfing pattern on the lows. This is not even with trend here. Like, the market's coming down. Boom, 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 boom. This green candle engulfed this lower body range. Well, it actually engulfed all 2 of these, which is a massive engulfing pattern. But nonetheless, that was the first entry. It engulfed, takes a trade, boom, quick, tight target. Look at the size of the stop, the size of the target, slightly bigger than a 1-to-1 risk-reward ratio on this template. Here's another example. The pullback's coming back, engulfing pattern, boom. Comes in, takes the trade. On the rip, take a break of structure. Another engulfing pattern right after the break of structure. Followed through. This one came really close. Hit stop. Okay. Came back. Here's the deeper pullback. This is more of a liquidity sweep, engulfing pattern. You're going to get these a lot, which is why I love this template. This is why I love this system, is because it doesn't matter if you're trading with the trend, if you're catching the reversal, if you're in an oscillation, or if you're trading with just a big leg, you are going to have these patterns. And almost always these patterns are going to produce a reaction out of the market. How many of you guys have heard me tell the story? And I'm going to do this for those of you that are new in here. Okay. It's very important. You've heard of the laws of the universe, right? The laws of the universe, right? Some of them would be considered gravity, right? Right? The law of lift. That's how airplanes get off the tarmac. Let's talk about this. And I'm going to do this. I'll keep it fast for those of you who've seen it before. If I have me and I'm standing here and I have the ground right here and I drop a ball, okay, what is going to happen? The likelihood of this ball hitting the ground is guaranteed. Why? Because of the law of gravity. There is going to be a bounce. We know this. That is called the law of cause and effect. Okay, by dropping it, it is ground to hit the ground. That's called gravity. The reaction is the law of cause and effect, which is basically dictated by force, right? But what the problem is that you don't know the reaction. And as we start getting further out in the equation of that bounce, we don't know, is it going to go this way? Is it going to go that way? Is the ball going to go this way? We know without a doubt that most likely we can ascertain almost with a very, very high degree of certainty that we can dictate the reaction at the very onset of that bounce. We have less likely for the failure of picking a direction, right? So if I have a trade signal and I know that the law of force on an engulfing pattern is very, very much like knowing that anytime I get this pattern, it's expected to have a quick reaction in a certain direction. I don't need it to go way up here. I don't need it to go any further. I just need it to go a certain distance, which gives me a high probability because I'm not trying to pick the market. I'm trying to catch a reaction off of a quick signal that has force. It's like when I drop this ball, think of this as me dropping the ball. And every time I drop that ball, it gives me a push, boom. That's the whole point of this. And whenever I get this, if I drop the ball, I'm dropping the ball. Let's take a look. I drop the ball right here. Boom. Drop the ball. Right? There's the signal. Boom. Force. I drop the ball. There's the signal. Boom. Force. Even here, I dropped the ball going this way. I had the force. There was enough there to show profit on the trade. It just didn't hit the full target, but I still got the movement. You see where I'm going with this? It's the power of acceleration. Here's another. I drop the ball. Right. Force. Boom. Target. Here. Drop the ball. Quick target. Boom. This one here. I think it caught the short right there. Short target. Boom. Short target. Boom. Drop the ball. Drop the ball. Target. Do you guys see where I'm going with this? There was one stop out there in 1, 2, 3, 4, 5, 6, 7, 8 trades. You understand this, guys? Give me a yes if this makes sense to me. Because 90% of all retail traders are trying to predict. This is the frickin' problem here. You're trying to change the laws of the universe. You have no control over this. You are trading in the market. You are dropping a ball. And what you're always trying to do is say that I know the market, the ball is going to go there. There's no freaking way that anybody in here, including myself, knows how freaking far that ball is going to bounce and at which direction. But I know it's going to bounce. It has to bounce. The law of gravity will prove that it bounces. Your job is to exploit the probability of the reaction off the ground in the market. And don't worry yourself about the guys that are trying to pick this and pick that, because they're very, very unlikely going to stay funded as a prop trader doing this, because every day is different and every trend is different. Every condition is different. And if all you need to do is focus on the very high degree of laws of probability that you can control within a very short frame of context, I'm taking now 4 years of stats and throwing it into quant algo strategy stuff and trying to teach you why most traders don't take profitability in day trading. And we're fixing that by taking the force out of the signal and just being able to extract that with momentum. That is the purpose of this system. And it takes the guesswork out for you. You don't have to think. The market move is going to give you a reaction because engulfing patterns are an engulfing situation and we're using volume for it. Let the algo do the work. Exactly, Brad. Exactly. Make sense? Same thing here. Let's take a look at the S&P. Really, really good chart on the S&P. Like this is what I love about this system, okay? You're never going to come to me and say, Sean, I didn't get any trades today. If you wanted to buy a franchise and you wanted to buy a Burger King or a freaking KFC or a McDonald's, you would want to know that that is in a good location. Yes, give me make sense. If you bought a restaurant, you want to make sure there's some foot traffic so people can come in and buy the burgers, right? If I sold you a strategy and I showed you this really, really great optimization and it had very, very few trades, there's a different place for that. There are some reversal strategies that are very, very, very effective with very few trades, right? But they don't happen a lot. And if I'm looking at this system, do you see a shortage of trades in here? Do you think that there's a shortage of activity? Right. That's a positive thing. You want to know why? Because that means our sample size is consistent on a daily basis, which means that I can ascertain reactions on a daily basis. This is very close to when I look at order flow strategies. You know what's best? Out of all the trading systems that we've produced, this is the closest thing to the HFT algo that I've ever seen because it repeats itself on a very, very consistent basis without having to deal with order flow. It's a very, very hard thing for me to find. We found it with this system. And that's why I believe this strategy belongs in every person's toolbox because it's going to hit and it's going to hit daily. Let's go into it. I promise you that I wasn't going to focus on fluff. Let's just go into it. How many of you guys can see the reactions? Like, it's just little bites. I'm not trying to swing for the fences. I'm just trying to catch bites out of the market. I don't care if the market trends this way. Like if I got a trade here, if I got a signal here and I'm out here, do I care about catching this move? The inexperienced will. The new guys are always going to be upset they didn't catch the whole leg. The guy that understands the alpha behind the signal is going to realize that I don't care because I know that the next time I get the engulfing pattern, that's like me dropping a ball. I'm going to get a reaction. I'm expecting it. I'm expecting it with a high degree of certainty. Okay. That's 100 trades on the S&P in the last 3 weeks, I think it is. Let me take a look here. Yeah, 13th to the 7th. Not even a month. 100 trades. Okay. It's on a 7,000 volume chart on the S&P, which I think, Jeff, is like what? The equivalent to like a 1 or a 2 minute? Maybe a 3 minute?
It's like 3, 4. And it's not quite 5, something like that.
Yeah, it's like a 3 minute chart. The 7,000 volume chart is like the 3 minute. Right? On the NQ, same thing. The NQ is let's take a look here. The NQ is an 8,000 volume chart. Yeah. Like that's a lot of activity, right? To produce, 18,000. I think it's risking what, $500 a trade, Jeff?
That's correct.
Yep. $500 a trade. So if you were risking $250, just cut those numbers in half. Most traders trading a 50K eval will not be risking $500 a trade. They'll be trading about $250 a trade. But think about that. If you're trading a 50K eval, let's do the math. This is fun for me. 50K eval. I cut that number in half to 250. I cut that number in half to 8,300 in profit. How much do you need to pass the 50K eval, guys? What's your target? Anybody here want to tell me that there's a $3,000 target? 3K? You've passed times 2 times in less than 3 weeks, in 3 weeks, right? That's key here, okay? on a $250 risk per trade. So how many of you guys are in it to win it? Give me a yes that you learned something today. Did you learn something today? We have a guarantee. Why do we have a guarantee? Because we understand that everybody wants it. So we give it to you. Maybe Ash, Jim, Jeff, you guys can post a link in the chat box. That would be great. And the reason we do this is because a lot of people are sick and tired of feeling sick and tired. Okay. And let me just see if there's a link here, guys. Between the four of us, we should be able to get a link together, huh? Let's take a look here. Make sure it's not. Make sure
I
when you
got one
post
here,
it-
Sean. I got one
Yeah,
for you.
appreciate it. Yeah, that'd be great. Okay, it was being posted, probably not to everybody. Okay, so there's the link. Okay, so the reason we do a guarantee is because we understand that when you guys buy something, there's nothing worse than having buyer's remorse, right? When I go and buy a desk or a couch or a TV, if I don't like it or something's wrong with it, I need to be able to know that I'm covered, right? So we have a 30-day love it or swap it guarantee. You cannot swap algos on launches. Okay, you cannot swap algos on launches. We do that because it costs us hundreds of thousands of dollars to build them. We're also a business. We need to sell software to keep the companies running. We're just transparent about that, right? There's no hidden agenda here, right? Like we give huge discounts when we launch the products. Everybody benefits from that. And if for 30 days or less, you're not completely satisfied, you can go into the business and swap it for the other 100 products that we have on the website. Okay. Now, tomorrow we have an AMA. Okay. An AMA event is basically designed to basically go over all of the things that you must know in order to become effective for using this algo. Why? We want to go through all the settings. We want to go through the use. We want to go through the templates. We want to go through all your questions. The best way to do that, okay, is by being a part of the event. We're going to be there with our R&D team. Jim and Jeff will be there. Our ambassadors will most likely be there as well. And this is where you need to be, guys, if you're planning on using this system. Okay. So what I'm going to do, great. Okay. And the AMA is tomorrow. Right. And thank you. Right. Thank you. Appreciate your guys' attendance, your guys' interest and passion in our products speaks the world to us. Love being able to help you guys and seeing the guys' success. Make sure you join the Discords for this. There's going to be a lot of action. And a lot of people in here are going to benefit from that. So just make sure you get active in there. And if you have questions, let us know. Traders, have a fantastic day. And we'll see you guys on the charts. Take care.